Hello everybody, thank you for joining us as we discuss the key trends and challenges in the global transition to a lower carbon future. We are delighted to have Kingsmill Bond, energy strategist at Carbon Tracker, joining us today. Hi Kingsmill.
Hi Michelle, thanks for having me on the show.
Not at all, thank you very much for joining us. Let's start with peak oil demand and where you see that going to very much set the scene for this discussion.
So I think we at Carbon Tracker tend to make three key points. First of all, that fossil fuel demand is peaking, and those peaks are happening right now. And it's not just us, it's DNVGL, for example, made the same point a couple of weeks ago. Now BP is making the same argument that oil and fossil fuel demand are peaking, that the 2020s will be the peaking decade. And then the point then is that the impact is felt on stock prices immediately. As you can witness with the European electricity sector, the coal sector, the oil services sector now, it's not as if we have to wait for the impact to be felt. The impact's felt right at the top. And therefore the consequence of that is that countries and companies which are dependent upon business as usual and the status quo need to change quite radically, and they need to change fast.
Is that message getting through? Of course, we have these very high level, very detailed and increasingly influential reports coming through. But is that message that you just described, is that actually hitting home beyond the new energy majors who have obviously made major steps to commit to net carbon by 2050 at varying stages?
I think we've got to realize that the drivers of change are not the incumbents and not the current energy majors. The drivers of change are the new providers of challenging technologies, the solar companies, the wind companies, the developers, and the battery companies, the EV companies. Those are the people who are driving change, and actually the victims of change are the incumbents. And the incumbents, having resisted change for as long as they can, having been in denial, have finally started to take their head out of the sand, but actually they're in desperate trouble because they're so far behind the curve. And actually what you're seeing now coming out of companies like Shell and Total and Repsol and BP is a kind of desperate attempt to catch up, and you have to recognize that they're behind the curve. They've got enormous balance sheets, totally dependent upon the current system, and they're moving from tinkering with renewables to putting maybe 10% of their capex into renewables, which is 1% of their balance sheet. Now, that sounds great, but it's definitely not enough. If they want to take this thing seriously, if they want to survive this energy transition, they're going to have to do a lot more.
Well, that feeds back in you saying about clean tech deployment, and that really is the trigger that needs to be switched so that we can start making these huge shifts. But that brings us back to an age-old argument about government policy, and that the policy and the regulations from the top down still aren't as supportive as they need to be. Would you say that's still the case?
Undoubtedly, and it's but fortunately, the primary driver of this transition, as in so many other sectors, is technology. So it's been the spectacular fall in the prices of solar and wind and electric vehicles and batteries, which has made possible the extremely rapid deployment of these new technologies. And governments, I have to say, have kind of been like following in the footsteps of the technological evolution, and therefore the kind of the bans and the support to these sectors have almost come after the event. So it's not to underestimate the importance of governments, because governments are clearly extremely important in order to kick off the technologies at the early stages, and in order to set a clear regulatory framework in order to drive change faster. But fortunately, the suite of opportunities available to government is now far greater than it was because of the technological evolution. And the key point, again, to stress on technology, it doesn't rest. There's superb analysis from coming out of Oxford University at the moment showing that the learning rates of these new energy technologies are extremely sticky, and the learning rates will continue. So if solar and wind are cheaper today, they're going to get 5 or 10% cheaper every single year for the next 10 years. And that just means that the pressure upon the incumbents is just going to get more and more intense.
As part of these energy majors, and of course other energy companies as well, as part of them playing catch up, some of them doing so very dramatically, as we've seen with BP and others, Does there need to be a lot? We're beginning to see some engagement between them and technology companies as well, and that nexus getting stronger and stronger. Does that need to accelerate dramatically within the next 12 months to start really starting major change? Is there enough going on?
Well, as I say, I think the people who are really driving change, you want to be looking to the solar companies, wind companies, where they're continuing to drive very, very rapid growth. It's really a question of a little bit too little too late in the case of the current fossil fuel majors. And you actually see that in the write-downs. And we've seen $90 billion of write-downs in the oil sector in just the last 3 quarters. And that, I would suggest, is the tip of the iceberg, because what happens as you move from a state of growth and the expectations of growth to a state of decline is that you get lots and lots of stranded assets. And we've already started to see stranded assets being written down, but think about the refining sector, think about the petrochemical sector, huge amounts of overcapacity, and people are still in their wisdom, still building new stuff, which is very, very naive.
So is now a good time for those energy companies to ramp up, those more traditional energy companies to ramp up their alliances with these new energy companies, more innovative technologies, and essentially use them as a life raft in this energy transition? Our way no longer is relevant. Your way is increasingly relevant. Will you essentially help us? Will you partner with us?
Yeah, I think that's the wise thing to do, and it's increasingly, of course, what is happening, and you see that with the majors taking big stakes in solar companies and wind developers. The problem, the overall problem, is that when you think about the rents which are available, rent being defined as easy profit, should we say, the rents which are available to incumbents in the fossil fuel system are actually much higher than the rents available to players in the renewable energy system. And as you get more supply in a world of weak demand, it's just you're going to see a big shift of the rents from producers to consumers, which actually is great for global consumers. It's great for the world, but it's not necessarily great for the incumbents.
Absolutely, thank you. And in that vein, which sectors would you say are most vulnerable to the energy transition? Would you say specifically the fossil fuels, or within that petrochemicals?
So at Carbon Track, we wrote a report recently called Decline of Fall, where we looked at this very specific issue and we tried to figure out who was most at risk. And I mean, you can identify 2 or 3 obvious areas. So one area is the people who build the new machinery for the expansion of the fossil fuel world. So that's to say the people building gas turbines, the people building new offshore oil platforms, the people building new petchem plants. I mean, if you're going to start declining, you just don't need any of this stuff. So that demand for that is going to collapse, or it has collapsed in many instances. Then you, of course, your secondary vulnerability is anyone at the top end of the cost curve, simply because, to state the obvious, as demand moves from growing to declining, then assets at the top end of the cost curve are no longer required. There's a big facet of Carbon Tracker's work, and they'll have to be closed down. And then I think, finally, your economies and societies which have built socioeconomic infrastructure upon the expectation of continued high rent are also obviously extremely vulnerable to the ending of that high rent.
Okay, thank you. And just to delve into the petrochemical industry a little bit more, there's this, as you've already touched upon, that it's a very oversupplied market, and there's up to $400 billion US that's going to be getting invested into perhaps 80 million tons of new capacity coming up, as I say, in an oversupplied market already. In terms of changing the tide on whoever holds those purse strings, or the entities involved, to take some of that financing and reallocate it to upcycling, or reallocate it to recycling, creating new supply chains so that this plastics world, which is obviously very linear at the moment, becomes much more circular as part of this push for a circular economy. How realistic is that? What needs to be done?
Well, we at Carbon Track, again, we just released a report on the whole plastics industry, where we looked at this very issue. And it's quite surprising, because the reason we started to look at this, because there's an enormous disconnect between the plans of the plastics industry and for continued growth, basically a doubling of demand in the next 20 years or so, and the reality, which is that we've just at the very start of a massive war against waste and a war on plastics. And the point to me is that the industry is quite flabby and has got huge amounts of externality and cost and waste. And actually, it's very hard to get your plastic demand to zero, but to stop the growth is actually relatively easy. There's lots of things that can be done in order to reduce the growth in demand. And this is the point we made in the report, which is that the industry is remarkably tone deaf to expect continued very, very high growth in the face of a changing society and governments which are putting on new taxations and new regulatory structures, businesses which are coming up with new solutions, and society which is no longer prepared to tolerate unabated plastic pollution. So it's therefore going to create huge amounts of stranded assets. And if I may make one further observation, there is this idea knocking around that petrochemicals is a kind of like diversification away from oil, and it's a better use of your capital to move down the value chain. This is a complete misapprehension. It's not diversification. It is in fact a doubling down on an even dirtier form of oil use, and it means that you are applying huge amounts of capital into an extremely risky, oversupplied industry. And we fully expect that a combination of cooler, saner heads from investors and indeed from governments will see the cancellation of many hundreds of millions of tons of new planned petrochemical capacity in the next few years.
So we're at this stage now. By 2025, what would you see the petrochemical industry looking like, taking into account what you're saying about those growth abilities to curb growth in demand as well? How significant do you think how significant will the change be?
I think you need to be looking at what's happening in Europe and China right now, where you've got an increasing push from governments, society and business in order to drive a more circular economy, new ways of recycling plastic, new ways of using plastics. And therefore, I would fully expect the innovators and leaders of this industry to do what some are now already starting to do, which is to move into new types and forms of recycling, and also into alternative solutions. And that is probably where the future of this industry lies, not in the old idea of just churning out more and more regardless and let society pay for it.
More pushing towards that circular economy and really embracing it due to market forces and public.
Yeah, and I think if I may, we obviously at Carbon Track, we're not plastics experts. We've used the work of people who are, but we are, I should say, experts in this whole stranded asset debate. And what's happening in plastics now is extremely reminiscent of what has happened in other areas of the energy system. Go back to the European electricity sector 12 years ago. It was a very similar story of a little bit of government pressure, a little bit of uncertainty, and new people coming in with new technologies. Or look at the transportation sector 5 or 6 years ago, and there's people like Elon Musk come in with new technologies, and at the beginning they don't really work, and everyone's very skeptical. And then lo and behold, costs get low enough, and the old way of doing business is no longer valid. So I really like to stress this is not, in fact, a green or even an ideological argument. This is a pure business observation about disruption in sectors which have become very lazy and very subject to the forces of inertia.
The question is, how long will it take for the economics to start speaking for themselves, so that those, as you described them, tone-deaf petrochemical entities start being forced to listen? And then that will, of course, be a numbers game.
Well, I mean, fortunately, of course, it's the market that forces people to listen. And, to take a look at the prices of some of these intermediary chemicals. Of course, that's as a result of the demand destruction caused by COVID. But if you get a combination, as we've seen in other areas, of demand destruction caused by COVID, and then added to that increasing regulatory intervention by governments and new solutions from businesses and new desire from consumers, and actually the notion of rising demand can vanish, as it has done in the oil sector in the last 9 months.
Absolutely. And saying about market forces, one of the things that we can round up on here is putting a price on carbon. and your view on whether the urgency to do that has abated somewhat, perhaps because the cost of some renewable projects are becoming comparable, some, on rare occasions, even cheaper than fossil fuels. Do you think that from a policy point of view and a momentum point of view, that urgency to put a price on carbon, be it on a regional basis, be it on a global basis, industry basis, do you think that's easing, or is it more urgent than ever?
It's more urgent than ever, because we, even under the Paris commitments, and even under the most optimistic current forecasts of people like DNVGL, we're still heading for over 2 degrees of global warming by the end of the century. So you do need governments to start to price this stuff. And to give you the numbers, it's extraordinary. So 15 years ago, only 1% of carbon dioxide emissions were taxed globally. Some great data from the OECD on this. Today, it's now 20% and rising. But the total cost per ton of carbon dioxide is in the region of $100 per ton. And lots of ways to calculate it, but let's take that as a starting point. From the deaths from pollution and the consequences of global warming, the fires and the storms and all the rest of it. It's $100 a ton. The average tax at the moment is $18. So it's a really dumb debate, because actually people are really paying this cost. Like, people are paying for it in their lives and their livelihoods, and the costs are being socialized. So it's not like we don't pay, it's just that people who emit the pollution don't pay. So therefore, governments are increasingly waking up to this as a real issue. And as they've done in many other sectors, they're internalizing the externality, as it were.
Brilliant. Kingsmill, thank you so much for your time. Really appreciate it, and your insights. And we hope that you can join us again soon.
Brilliant. If I may make one final observation, I think the world of energy forecasting is changing, and you see that even within the last 2 weeks. So we have fought a Carbon Tracker sort of long and lonely battle, trying to persuade people that the energy transition was happening and it was significant, and almost all of the incumbent forecasting companies very, very closely linked to the current energy incumbents, and they were all saying no peak until at least 2040. It's all fine. There's no problem. But actually, you see within the last 2 weeks, I say, a very radical shift now starting to take place. It started with DNVGL saying that we had peak fossil fuels in 2019. It continued with BP last week saying that possibly peak oil in 2019. It's continued now with the front page of The Economist this week, I see, saying that we need to recognize that this has huge implications for geopolitics and for business because of disruption. So the world is changing, and I would urge the energy forecasting industry to stop being behind the curve. Thank you.